Valens Research, Uniform Financial Analytics.
Right, so Hologic, for those of you who don't know, really focused on women's health. It's one of the few companies in basically the healthcare companies that really just hones in on helping with women's health from a medical device perspective. And so, right, you imagine that you think, okay, a company that is working on a kind of if you will, undercovered part of the industry, you'd likely see higher returns than you would normally expect. But when we see here, what we can see is the opposite is true, right? What you're looking at here is the first page that we always come to when we look at a company. The first time you type in any ticker, you always come to this page. It's called the PVP page, right? Why is it called PVP? Because again, we're very literal people here at Valens. It is the performance and valuation prime analysis. Performance, why? Because we're looking at the performance of a company. Its fundamental performance, whether it's return on assets, and what are its asset growth, if you will, how strongly profitable is the business, and also in terms of asset growth, how much is this company reinvesting in itself? And then valuation, because we're also looking at valuations in terms of valuations relative to assets, valuations relative to earnings, and how the company has performed relative to the market. So looking at Hologic, like I said, right, you would expect a company that is in a growth industry and also in an underfollowed part of the industry, women's health, that you would expect to have higher ROAs. On an as-reported basis, though, this company had a 10% ROA last year. Before that, it was basically a 5% ROA business every single year at best. Now, this looks like a low return business that might just be having an inflection now, but it's not that compelling. It's only when we look at the uniform accounting, right, the true blue uniform accounting for this company, that we see returns are actually 4x what as reported metrics show. And this isn't a company that has had middling returns. It's consistently been above 25% ROA business every single year, other than 2013, for the last 10 plus years. Right, just for context, the average company in the US right now generates around a 10% ROA, 10 to 12%. Right, this company is generating almost 3 to 4x those levels right now. Not barely 10% levels that make it look like a middling company at best. You misunderstand this company and if it has competitive moats, if it's a high return business, if you're looking at the as reported metrics. But it's not just that, right? When we look at asset growth, we can see how asset growth has also been distorted for Hologic. You would think this company shrank in 3 of the last 5 years when it's been growing every single year. This isn't a low return business that's been shrinking. It is a high return business that can reinvest in itself. It's the exact kind of business you'd actually want to spend some time looking at. This is a really compelling, really high profitability business, just from the perspective of how it returns. And then the question becomes not just how good is the business, but does the market understand it? And that's where we look on our uniform accounting basis, right? The true blue uniform accounting bars for a uniform price to book relative to as reported. We can see as reported metrics slightly overstate this company on a price to book basis. And as reported metrics for a few of the recent years, right? As reported PE has also overstated how expensive the company is. Right now, the company's as reported PE is about accurate. But right, this gives us context in terms of what's going on valuation and performance. And the last thing that we look at, as I mentioned, is TSRR. TSR relative to the market. TSR stands for total shareholder return. Think of it as the total income you can make in this company between stock appreciation and also dividend income for the company. And then the R relative to the market means when this line is flat, the company performed in line with the market. When it rises, that means the company outperformed the market. And when it falls, that means the company underperformed the market. What's really interesting is more often than not, what we can see is this TSR tracks what's going on with the returns and the asset growth for a company. As you can see, when ROAs were rising for the company and it was rapidly investing, TSR outperformed the market. When returns peaked and then started to roll over and it stopped investing, TSR rolled over. When ROA started to rise again, right, it started to rise, fell as it fell. And these trends, you can see even, they're not representative for tracking on the as reported metrics. It's only when we look at the uniform accounting metrics that we can see right, what the market's thinking. Because the market doesn't pay attention to arcane accounting mathematics. The market pays attention to the world of companies, which you can only see if you look at the right data. But understanding just what a company has done historically is not enough to understand if a company is undervalued or overvalued. That's where these light blue bars and white bars here come into play, and we use them. What you can see here, the two light blue bars are what Wall Street sell-side analysts are forecasting the company to do, Hologic to do, for the next 2 years when we take their numbers and we push them through uniform accounting. Right? The market, analysts, Wall Street analysts are expecting ROA to peak at 50% plus in 2021 and then possibly fall off to 30% in 2022. These white bars, they're what the market is pricing the company to do at a $20 billion market cap and a $76 stock price. What we're in essence showing you here with these white bars is if you think that the company is going to do returns that are in line with these white bars based on what you know about the company is fairly valued because that's what the market expects it to do also. But if you think the company can exceed these expectations, right, the company might be undervalued. So just as an example here, and what we can do is we can use the embedded expectation tool, which is a very quick scenario analysis tool that we have to see what the company would be worth in different potential scenarios that we might have for the company. And right, this is the power of using the Valuations Research app and the Uniform Accounting Framework. It's not just that you have a better understanding more quickly of what a company's real historic profitability was, right? A picture is worth 1,000 words, and especially a picture that's accurately painted as opposed to as reported distorted numbers. It also gives you the ability to do rapid scenario analysis, so you don't have to build an entire Excel DCF model to understand what a company might be worth. Right, so let's say that we think that a 5% asset growth number is reasonable for Hologic because that's what it's grown historically. But we also think that it's not going to see ROA fall back in 2022, and ROA could actually rise and then plateau at around, let's say, 40 to 45%. What might the company be worth? What we can see is in this scenario, if we actually think Hologic will plateau at around a 40% ROA going forward with modest growth, this company isn't worth $70, it's worth $120. And right, this is what we can do. We can quickly do this kind of scenario analysis using Uniform Accounting in the Valuations Research app. And the reason why we can is because we can have a better confidence in the numbers that are backing it. And then you can have a debate, right? If you want to talk with the other analysts, the portfolio managers on your staff to understand if they think this scenario is more reasonable, or they think this scenario, right, where the ROA basically is flat at 2022 levels is more reasonable, you can have that debate, but you're going to be having that debate based on real data as opposed to distorted as reported data.
Valuations Research, the world's leading source for uniform financial analytics.